Hi, it's John Mousseau. It is Friday afternoon, September 10th. I'm the CEO and Director of Fixed Income here at Cumberland Advisors. This week in the bond market, not much movement. 10-year bond at a 134, 30-year bond at a 194, but probably a 10 basis point movement within that range. So there was plenty of movement for what you would call a short week. Muni's well bid for. 10-year Muni AAA at a 0.94, the 30-year at a 153. Very tight ratios to treasuries. We expect that to continue. That's reflected in about $1 billion again coming in muni bond fund flows. Corporate issuance this week, big, $76 billion. That's corporations taking advantage of very low interest rates. The market was expecting maybe $45 billion of issuance. They got $76 billion, and it was all well spoken for at fairly tight spreads, around 87 basis points or so. On an investment grade spread level. I think what's really important is to look at some of the stats this week. Initial jobless claims down. They were expecting 335, they got 310. Let's look at something like producer price index. We have a couple of graphs. Here's the monthly graph. They're expecting 0.6, they got 0.7. Interestingly enough, if you looked going back to the years prior to COVID, monthly average is about 0.1. Since COVID, going back the last 12 months, it is average 0.7. That tells you something, that you're starting to bake some of this in. The Fed thinks this is transitory. We will see. Let's look at the year-over-year numbers in PPI. It is at 8.3. Clearly, it has taken off. We would expect the slope of this graph to start to slow down and those year-over-year numbers to come down as you get smaller monthly numbers. The real key for the bond market will be, do those monthly numbers slow down and you get to a point where they would level off, whether it's CPI or PPI, somewhere in that 0.3 to 0.4 range, which would tell you you'd have an annual inflation rate of somewhere around 3.5 to 4.5, or does it go back to where it was, where we have 2% inflation? It's hard to believe that you're going to basically ratchet all the way down to where we were pre-COVID. So eventually the bond market has some reckoning to do with that. The question will be when it starts to reckon and how fast it will reckon with it. That's another reason for maintaining a defensive component in bond portfolios, for sure. Next week, of course, we're going to have initial jobless claims again. We will be looking also again at the University of Michigan confidence numbers, very important on the overall economy to look at that. And I would leave you with the last thing that we saw this week was the JOLTS number, which really shows the number of job openings out there, which is like 11 million versus unemployment out there of 9 million and change. It tells you there's a mismatch of jobs with people looking for jobs. There's more jobs than there are people unemployed, job openings. Eventually that comes together. We think an infrastructure plan is part of that solution. We hope Congress can get to that, and we will see. We hope everybody had a great Labor Day. Next week is a very full week. We're going to see about $11 billion of muni issuance. First time we've seen that much issuance in a while. So maybe we see a little give in the markets there. We want everybody to have a good weekend, and we'll see you next week.
Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors, September 10th, 2021. A lot of sluggish action in the market. I'm not going to call it real fierce downward action this week, but just sluggish. Supply outstripping demand throughout the week, all 5 days. Did see the growth in larger names hang in there a little bit better than the broad market. You look at the Russell 2000, which we like to use as a proxy for breadth, quite weak, 3% or so down on the week. NASDAQ, where we like to think of as our index for pure large cap growth, down, let's call it 1%, although it was even less than that. So we'll keep an eye on that area. We've got a couple of charts to share with you, just to share with you some volatility that we see during the year. And also, we often get asked by clients and prospective clients about some of the Quantitative analytics we use, whether it's relative strength or trend, to try to differentiate risk and reward opportunities. You know, it's sometimes not enough to know what you want to buy, but you have to add in when you want to buy it, when you want to sell it. What is the risk in those two areas? If you look at the first chart that we've put up here, this is relative performance versus the S&P 500 of a handful of ETFs that cover small, mid, and large cap growth and value, as well as high dividend yield, low volatility, and momentum. How have they performed versus the S&P this year? You can see year to date, small cap value still riding the early year strength, that January, February, March strength, to outperform the S&P through today. IVW, the second rank there, that's large cap growth. Not very often, small cap value and large cap growth both outperform the index. You know, in thinking about a dichotomy of styles, right? Small cap value, very different characteristics than large cap growth. We use this to try to see if there's any consistency in price action. While we look at a broad picture here, this next chart narrows it down to a 3-month look. And this is where you really get some action in terms of volatility among styles. Look at the difference in the 3-month versus the year-to-date year-to-date chart. Small cap value down 12% versus the S&P over the last 3 months. So it's gone from year-to-date still being up 2% to being down versus the S&P by 12%. Real weakness. Yet when we look at large cap growth, nice and steady. The highest style return versus the S&P this year. What we like to do is take a look at what has been beaten down, such as small cap value, and start to look on a daily and weekly basis, look for that to narrow versus the S&P. So we have some small cap value ETFs up on our screen that we look at daily. Are we buying them here? No. Are we interested in seeing some relative strength come in? Absolutely. You know, if that continues to widen, we'll just stay away. But money can be made when trades narrow. Think back to August and September of last year. We're looking at a similar scenario. 3, 4, 5 months prior, small cap out of favor. Couldn't catch a bid. Boom, September through March of this year, you could not make money if you weren't in small and mid cap. So we'll see if that occurs again. Very interesting. What are we worried about in this market? Remember, we often like to say, control the downside because the upside will take care of itself. We talk about that in our investment meetings continually. The biggest thing that I'm watching day to day, week to week, is this large schedule of supply coming into the market. When I say schedule, large IPO calendar. Between now and the end of the year, over 100 IPOs on the calendar. Now, not all of them are large. Some of them are very small. But that's a heck of a lot of supply coming into the market that needs to be absorbed. When we couple that with the near daily secondaries being put out by companies. Remember, as your stock price goes up, if you'd like to raise money for your balance sheet, you sell stock to the public. You sell stock. It's a secondary offering. You're seeing Snap secondary offerings. Those are secondary offerings with not a whole lot of lead up, but the market is so strong in those names, they're able to push out whatever it may be, 500,000, million, 2 million shares. That supply into the market needs to be absorbed. So we may see some back and forth in the near term while that supply gets absorbed. We'll keep an eye on it. We'll report back to you next week. Have a nice weekend.